Hey, it's Mike Ambright with FlipNerd.com. Welcome back for another exciting expert interview where I interview successful real estate investing experts and entrepreneurs in our industry. Today, I'm joined by my friend Tim Norris. He's the president of National Real Estate Insurance Group, which is a large real estate insurance group that caters to real estate investors specifically. And we're going to talk about the importance of being properly insured today, which may include some level of being self-insured. It's not a topic that gets talked about when you're not dealing with insurance companies that focus on real estate investors because they don't quite get this. They want to be able to overcharge you. I should also say that National Real Estate Insurance Group is one of our platinum sponsors of this show, and actually the insurance company that I use for all of my rental properties. Tim is one of the best resources I know in the insurance space by far, and actually a good friend of mine. So happy to have him here today. Before we get started with Tim, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days with rates starting as low as 9%. For more information, call 888-296-1697. B2R Finance makes loans tailored specifically for rental investors. They can help you unlock equity from existing properties so you can get cash to grow your rental portfolio. That's huge, and it opens up lots of opportunities previously not available to rental investors. Need a loan? Call 855-819-4412 or visit b2rfinance.com today. National Real Estate Insurance Group is the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. We'd also like to thank Crestar Funding, Mid-Atlantic IRA, and Renters Warehouse. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Tim, welcome to the show.
Mike, good to see you, buddy, as always.
Yeah, good to have you back, actually. So we kind of got a good laugh out of this. You've actually been on the show before, and this is going to be show number 234, okay? And the first time you were on was show number 2. Yeah, so it's been a while.
That is funny. That's the big 2, huh? As I joked with you earlier, I'm the bridesmaid, right? I was number 2.
Sometimes that's okay. We had to work out some kinks on number 1, and then we perfected it on number 2, and
that's good.
Awesome. Well, hey, great to see you. Hey, before we kind of get started, for those that don't know you and aren't familiar with your company, why don't you take a minute to tell us kind of how you got into this space?
Yeah, sure. We could probably take it more than the 45 minutes, but I'm just going to give you the nuts and bolts story. I was actually an insurance agent with a company called Nationwide. Many of you have heard. It's a national company. And probably about 15 to 18 years ago, I started getting involved in real estate investing. What did Will Rogers say? To buy land because God ain't making any more of it. Well, I kind of put buying real estate, God may be making more of it, but quote unquote, to kind of diversify my own income and always have something to fall back on. So I had met at the time a client of mine, it was Missy McCall-Hammond. You probably know Missy as well.
She's been on the show before, yeah.
Great lady, love Missy to death, and I consider her a real good personal friend and all that, and she's been a partner for a while. But she came to me, again, to try to make a long story very, very short, and you may not have heard this before, but she came to me, again, about 15 years ago and said, do you have any money? And, when anybody asks you that question, you're like, what do you want to have money? And one thing led to another, and what she was really doing was she was looking for partners. She had the systems, she had the processes, and she had the people to build a nice real estate business. But, the banks would only give her so much money as her. So she needed partners. So she was forming partnerships, LLCs, and needed call what I call the white collar side of it. She needed the money coming in to help form those. Well, I wanted what? Depreciation. I wanted some revenue, some cash flow, and some insulation, so to speak. And one thing led to another. And I think if you would ask her, she would admit that I was her first turnkey investor in her program years and years ago.
Yeah.
At the same time, I thought, you know what? I need to really get involved with more real estate investors like Missy. So I said to her, what do you think I should do? She said, well, we've got a group here in Butler County called the IPOA, and then you've got, of course, the RIA group. So I went down to a RIA meeting dressed up in a shirt and tie. I heard the word investors, and I thought, well, gosh, investors, this must be the big deal. So I show up there really nicely dressed. Of course, everybody's there in jeans and flip-flops and all that, and figured out very quickly that that market, if you will, and from the insurance industry's perspective, was very much underserviced. The
Yeah.
State Farms, the Nationwides of the world, they loved handling a guy or a gal with a house and a couple cars and a boat and an umbrella. And then the Travelers, the Hartfords, the big companies, if you had large apartment complexes, you had office buildings, retail spaces, they would love to handle that for you. But nobody was in that sweet spot, what I call the old Yogi Berra syndrome, hit them where they ain't. If you had 6 investment properties and you flipped a house every 3 months, the State Farms of the world, they're like, well, we don't want, that's not really in our space.
Right.
And of course, it was too small for the Travelers and the aforementioned Hartford. So I thought, man, there's got to be a way to do this. So at the time, the company I was with didn't do it very well, consistently. And a few carriers were out there doing it, at least on the vacants and the rehabs. And was at a real estate investors event for National RIA back in, 2008, and it was in Orlando. And I'm trying to take you somewhere, I promise. And I found a guy that had a program called Renovators Insurance, who started, of course, with the Homevestors franchises out of Dallas, who you know very well. But Mike's program, Mike Wren, his program really focused on the fixers and the flippers. The transactional type investor that needed coverage for 30, 60, 90 days. And call it what it is, my bailiwick, I wanted to deal with the missies or, the U's who had multiple rental properties where it was more static in nature. They may be adding and growing, but it wasn't as transactional, because to me, a transactional investor is a little tougher to deal with, not because they're not good investors, but because it's a lot more work on the front end.
Yeah, a lot of in and out.
Yeah, if you have a static portfolio of rentals, a little bit easier. And this is where I cut the 4-year story really, really short. My company, National Real Estate Insurance Group, merged back in late 2010, early 11, with Mike Wren's company, Renovators Insurance. And we're based in Kansas City. We went from the time when I merged and moved to Kansas City 4 years ago, believe it or not. I think we had it was 1,200 clients, or accounts, if you will.
Okay.
And we had 7 people on staff in our company, plus Mike, Becky, and I, the 3 partners, Becky Cole, who's Mike's wife, and our CFO. And now to this day, granted, we've expanded into other things, whether it be media or the private lending associations, the other things that we do collectively. I think we have 120 employees at last count. So it's been a lot of growth. And now we're insuring, I think it's 9,100 account holders. So about 8-fold in about.
And so roughly how many doors is that?
We count basically on units. So we're looking at last count, about 45,000 units, predominantly in the 1 to 4 family space. Now, of course, if investors, and what you and I would know is that, that Johnny Lunch Bucket investor space, they'll delve into small apartments. We're happily and easily able to accommodate those things, but most of our business is in that 1 to 4 family, if not predominantly, if not, I think 90% of our doors are in 1 to 4 families.
Yeah, that's great. And folks all the time, especially a lot of newer real estate investors, and even people that have been around for a while, they know, it's kind of like real estate agents. They know somebody who's an insurance agent, and so they're dealing with paying for an annual policy up front and having some issues whether the house is vacant or not, and kind of all those issues that make sense for an owner-occupant type house, but just don't fit the investor space. And like today, even the stats are roughly that 1 in 3 houses in America, or 1 in 3 homes in America, is owned by a real estate investor. And so it's kind of crazy that there's not more knowledge out there of there's not more, I guess, sources out there of insurance companies, for example, of how to kind of serve that crowd, other than, certainly the institutional folks have figured it out. But a big part of that 1/3 of homes in America is really a lot of smaller mom and pop type investors that own between 1 and probably 10 houses. So kind of talk about why that is. Why are there so few because you used to be on the other side, the agency side. Why don't they get us?
You know what? I don't know. And I don't think that's honestly anomalous to just the insurance side of our industry, because it seems like the education side, there's a lot of different facets, if you will. It's almost an under the radar industry still. I think when you get companies like Lowe's and Home Depot that started over the last few years to really take notice of what we do as investors as more of an industry, I think it's changing. And I think with the internet and the ability to garner information literally at a fingertip on a smartphone, it's changing. I think it's changing very, very quickly. But I still think the way insurance is done, at least with that call what it is, that interpersonal relationship predominantly with an
Right.
agent. Sometimes that agent's on an 800 number online, but still there's that, call it what it is, that, how do I put this in a good way? They call it is that intimate relationship that people have. You remember your agent your parents had growing up. Most people do.
Yeah.
Even that's changing a little bit with the ability to garner that information and literally a touch of a button at your fingertips. But
Right.
I don't know. I think it's just that it's so new as an industry. I think still, even though it's matured,
Yeah.
sounds contradictory. It's still new, at least from a recognized perspective as an industry.
I think probably because it's so fragmented. I mean, there's just so many, mom and pops that own one or two houses here and there, and I think that's part of the problem. They're just so fragmented.
Yeah, our numbers, at least in the insurance program, back that up. Our average client owns less than 5 units.
Wow.
Now, that counts the ones that have 200, and it counts the ones that have 1. But our average is a little bit less than 5.
Right. Right.
Depending on your perspective, that's not a bad thing.
Yeah.
There's just more people to serve, if you will. Versus having 400 clients across the country that everybody was after.
Sure.
I know you probably have better numbers than I have, but the last I heard, there are 2 million plus real estate investors in the country. Now that could be, Joe and Jane Smith with one location, or an aforementioned Missy McCall with however many she's got, however many hundreds she has now. But still, I think it's a good thing, honestly.
Yeah, it opens up a lot of opportunity. But hopefully for folks listening to this show that are looking for insurance, they're going to realize here when we talk a little bit that there's might be some better options out there than what they have today. So one of the things that was interesting when we first met, and we've have our rental properties insured with you, and we have for years, was the discussion around this idea of self-insurance.
Sure.
And I'll say I kind of do that in my health insurance. I have a high deductible plan where I cover in the instance we have problems, which we, knock on wood, we have had very few issues. We're kind of self-insured for that first, whatever it is, $6,000 or $7,000 for my family. But I think most people that deal with a traditional with a traditional insurance company for their investments, I guess even for their homes, like I think most people feel like for their individual homes, their personal homes, that they're over-insured.
Yeah.
Like the insurance company kind of says, well, no, we have to insure it to that value. And you're like, I could never sell it for that, right? But I don't know if that's just a gimmick to kind of get income in or what it is.
Gimmick might be a strong word, but it's you're right. And I think a lot of insurance companies, what they're trying to do, and we could get into the idiosyncrasies, technicalities of how most policies work, but typically you have to deal with an issue called co-insurance. In other words, you can't take a building, let's just use a single family, that is actually worth, if you will, and that word worth, quote unquote, is, how many worths are there? Tax value, appraisal value, reconstruction value, which is different from replacement cost, which is a term most of us, call it what it is, affiliate with the insurance world. But at the end of the day, what most of those carriers are doing is try to avoid what's called a co-insurance issue, for lack of a better term, and try to keep it in layperson's terminologies. And what that, again, in a nutshell means is you can't underinsure a property and expect to get the full, quote unquote, if you will, benefit of the insurance. So if you've got a building that would cost you $250,000 to rebuild, you can't insure it for $100,000 and then expect to get a claim paid, quote unquote, in full, less a deductible. If you think about it, the theory of insurance is that everybody that's participating in the insurance, again, call it what it is, world, is putting enough money in this big bucket. So when a claim occurs, like we had tornadoes blow through the area here yesterday, knock wood, not much damage we've heard, but that there's enough money going in that bucket. So when claims occur, there's not only enough money there for people to get paid and their properties to get repaired, but obviously for the insurance industry in general to make a profit. Because at the end of the day, I've joked with you before, it's, believe it or not, these insurance companies are in the money to make business, or in the business to make money.
Yeah.
That's really what they're in it for. So the co-insurance issue really relates to being, call it what it is, completely insured or sufficiently insured. You're paying enough premium into that proverbial bucket that when a claim occurs, there's enough there for people to get paid. So what these carriers did, and again, I could go way off the beaten path here, especially after Andrew hit, I believe it was in 92, and before that it was Hugo hit the Carolinas in 89. There were a lot of guaranteed replacement value policies in place. When Hugo hit the Carolinas, I don't know if you remember when Sears was with Allstate. That was back about that time. The problem was they were guaranteeing that they would build these properties back, even though they may have only been insured. Let's say one property was insured to 100,000. It cost them 150,000 to rebuild it. And on one property, okay, they didn't collect enough premium to offset that additional $50,000 of risk. Well, when you see tens of thousands of properties that were literally destroyed in an event like that,
Yeah.
well, there was a lot less money in that bucket than was needed to repair those. So what happened was then the insurance companies started to, for lack of a better term, making sure that they had enough premium going into that bucket. So what you see even today is, even though a property you may have paid $100,000 for it, it may be worth ARV 125. You'll get an insurance company come in and say, well, you need to insure that to 180, and you're left literally scratching here. 180? What do I need 180? I just paid 100 for it. I could get another one for 100. All they're doing is they're saying, well, you need to put enough in that bucket to make sure if we ever have a catastrophe again, that there's enough there to pay it out.
Yeah.
Collectively.
I see.
And you use the word gimmick. That's again.
Well, maybe that's a
word, but it's true. It is true. It is a gimmick. Because what the insurance company doesn't want to ever invoke what I've kind of alluded to, a co-insurance penalty, meaning you are underinsured by X percentage, and policies have different co-insurance requirements, 80%, 90%, 100%. You want to try to avoid co-insurance because anything that you're underinsured, and again, I'm trying to keep this high level and very, very simple.
Yeah.
Any percentage you are underinsured could be levied against your claim settlement and a penalty. So if you have a co-insurance requirement on a policy of 80%, but you're only insured to 60% at the time of a loss, that 20% shortfall, if you have a $50,000 claim, you might have a 20% shortfall, a $10,000 penalty before your deductible is taken away and before your what's called depreciation is taken away in a claim. Wow. So the reason, that gimmick as you put it, that these carriers have pushed those values higher, they want to avoid those things too, frankly, because, well, they like to get the extra premium, of course, but there's never a good thing when the co-insurance penalty is really applied. So my attitude is make sure that you're sufficiently insured, but if you can find a policy or a program that doesn't have a co-insurance, that has the ability for you to avoid it, then by all means avoid it.
Yeah, yeah. Hey, so talk a little bit about the idea of kind of, I guess, different ways that people could be self-insured. Some of that is high deductible.
Sure.
Some of that is, as you start to build a portfolio up, is you can get some kind of blanket policies, or those things you can do. I mean, as you have more and more properties, it's not like your whole. Let's say you had 50 properties, and like you said, a tornado rips through town. It's not going to take them all out. It might take a portion of them out, but just kind of talk of some ways that people can, some kind of high level ways that people could effectively self-insure.
Yeah, and you just kind of hit both of the bigger ones.
Okay.
No, that's okay.
Well, we're done here.
Yeah, exactly. Thanks. Good to see you. Take care. No, but a high deductible. My rule of thumb's always been, and if you go back to episode 2 of Flip Nerd, you probably hear me say the same thing: is take the minimum claim that you would ever file and double it. So if you're never going to file a $2,000 claim on your investment property, whether you own 1 or 100, then don't carry a $2,500 deductible or $1,000 deductible. For God's sake, a $500 deductible.
Yeah.
Go to a $5,000 deductible, because the cost savings over a period of time, by the time you do, knock wood, statistically have a claim, are going to probably offset that over a few years. So you've put that, call it what it is, that money back in your pocket, and then you've got a deductible fund. Whether it's real or imagined, you've saved that in the form of premium savings.
Right.
Now, there's a point of diminishing return. If you only have one investment property and the difference in, call it what it is, the savings percentage-wise between a $2,500 and a $5,000 deductible is 5%. Well, that 5% on your one property may only mean an $80 savings for the year for that investment. So, in that case, maybe not. But take that 5%, and now you've got 50 properties. Now it might mean a $3,000 a year difference. And the chances of you having multiple claims, frankly, aren't that good in the course of 1 year. The other one was that you just alluded to was the multiple properties. If you can get with an occurrence deductible versus a per location deductible. Now, of course, a fire is one occurrence, and the chance of having one fire damaging multiple properties in one, I guess Chicago and Mrs. O'Leary's cow, 100 or so years ago, it might have been the case. But today it's really to do with wind and hail and, tornadoes, those types of things.
Yeah.
To carry a per occurrence deductible, or let's say you're with an insurance company that has a per location deductible of $2,500. You have 50 homes, and 20 of them are damaged in a tornado or a hail incident. Well, 25 times 20 locations times $2,500 deductible, that's your deductible for that incident.
Right.
You could carry a $10,000 deductible for that one occurrence, likely shave off a considerable amount of premium percentage, knowing that you're limited to that exposure of $10,000, even if there are 30 of your properties damaged. So if you can work that out, not all carriers do it, and not all geographies with any carrier will allow you. You go to Oklahoma or even many parts of Kansas, for instance, where we are here in the Midwest, most carriers won't allow you to do that because they're afraid of the same thing you are, a large
Right.
incident like that. And if you really think about it, even with a $2,500 deductible per location, I mean, I don't know about you, but we can have a roof put on, in our area in the homes that we're investing in for a lot less than $5,000 or really close to $5,000 at most.
Yep.
I mean, you're self-insure those things anyway.
Yeah.
I mean, when push comes to shove, even on a per location deductible, you really don't have a lot of exposure as long as they're all insured. I think there are certain times that you can self-insure an entire property. You get one at a sheriff's sale, depending on the type of investing you're doing, for $10,000 or less, or even $15,000 or $20,000. You may be flipping it right away. You may be fixing it and flipping it, but until you have some value to it that's of significance, and that term of significance is very, very personal.
Right.
From the property itself, to go spend $150 a month for that property that may be worth at that time less than what the lot's worth. Why do it? The one caveat I think I'd share with anyone and everyone is it's very tough to self-insure something of unknown risk. So the property itself, you may know that house you just paid or bought at a sheriff's sale or a deed sale or what have you is worth $20,000. You know what you've got at risk. But to self-insure the liability is a little bit, to me, less secure.
Yeah, if somebody gets hurt on the property.
Yeah, some kids sneak in there with a 12-pack of beer at night, and you just thought, well, I'm just going to save the money. Oh, shoot, I didn't put liability coverage in. Somebody gets hurt.
Right.
Somebody gets hurt, somebody's getting sued.
Yep.
It's not just the actual exposure. You may really not have, call it what it is, negligence involved, but it's just the cost to defend that lawsuit, which is predominantly usually picked up by your liability insurance. That's what you're really worried about.
Sure, of course, yeah.
There are negligence claims, but more often than not, we call them nuisance claims. Somebody slips and falls at your owned property. Well, everybody gets that attorney letter periodically. It says, well, Joe Tennant slipped and fell, and you're at fault for it. Send us your insurance information.
Yeah.
And more often than not, the insurance company will defend it with their attorneys, of course. They may pay a claim out for $8,000 just to get rid of it, though you weren't negligent at all, because it costs them a lot less to pay it out than it does for them to defend it.
Right.
Still, self-insuring that liability is a little bit tougher nut to crack, I think.
Yeah. What kind of advice do you give to real estate investors? This comes up for once in a while when I'm talking to people, is what to insure the house for. Now, as real estate investors, at least in my world, we're generally buying houses at a pretty significant discount to market value.
Right.
And so my take has always been, if I have a claim, I guess I could self-insure more, but my take has always been, if I have a claim, I want to be made whole, as if I kind of want to protect myself from, I guess, my opportunity cost of what I could do when I sell that retail. So said another way, if I had a house that was $100,000 ARV and I paid, $50 for it and I'm going to put $20 in it, I would have a tendency to insure it more at the ARV level.
Sure.
Because I hope to get that money back out soon.
Yeah, and if
some investors like, well, I don't want to spend any more than I have to, so I'm just going to insure it for what I have into it. Yeah. Of course, if you had a total loss, then you would, you certainly wouldn't make anything. You probably would still even lose money. Yeah,
in your it's a personal choice. You just alluded to that. It's really how your business model works.
Yeah.
But most folks need to understand that just because, now there are rare exceptions to this, they're what are called value policy states, where whatever's on that declarations page, if that place burns to the ground, and there are different laws relative to this in different states, because insurance is still driven by the states. There's no federal oversight of property casualty insurance. But with that exception of that value policy state, you can, and I know many have, quote unquote, profited from an insurance claim. Well, really that profit, more often than not, especially in the real estate investor world, comes from a result of this. You have a claim, and let's just use a specific example, just throw some numbers out here. I'll keep the math simple because I was a history major. But yeah, you have a claim that does $30,000 irreparable damage on a retail basis, where, Bill and Betty Smith, who don't invest and don't have connections to contractors and deals at Lowe's or Home Depot or any of that kind of stuff, cost $30,000. And let's just say, to keep the math easy, you've got a $5,000 deductible. Well, even on a replacement cost policy or coverage, your initial claim settlement is levied with what's called depreciation. So let's just say the kitchen that was damaged in our fire was 10 years old. Now, in a real claim, depreciation is levied on a line item basis. So you could have a depreciation schedule that's 30 pages thick on a kitchen because cabinets don't depreciate as quickly as floor coverings do, those types of things. But just again, to keep my example simple, let's just say there was 30% depreciation levied against that $30,000 claim. So here's how your initial settlement will work. $30,000 less your 30% on 30,000. So you got 21 grand less your 5. So your first claim settlement check is 16 grand in my example. And statistically, most claims aren't total losses. They're really not. It's like 99% partial losses. So you get a check for 16 grand. You're a real estate investor. I used that term retail on that $30,000. Well, you could probably go get that work done for 10 to 12. You've done nothing wrong to take that check, get the work done, get the property back to livable or rentable condition, and take that difference and put it in your pocket. That's not profit. That's just simply you're taking advantage of your ability to garner those things at less than a retail basis. So in our program, even on replacement cost insurance, 80% of the time we pay out an ACV claim, or the carrier that we represent pays out an ACV claim. The insured does not come back for the difference. Why? Because to come back for the difference, you have to show that you've exhausted that ACV settlement and show need for and or receipts for the difference up to that $16,000 in my, or I'm sorry, up to that $21,000 in my example. 80% of the time, they don't do it because you and I and our, call it what it is, our peers in the industry, they don't pay retail for those things.
Right.
So I'd have a tendency to push investors, especially more seasoned investors such as yourself, into that ACV settlement, knowing that one, most losses aren't full losses or total losses, they are partial losses, and take advantage of the lower premium you could pay to garner that actual cash value insurance, believe it or not.
Right.
So, go ahead, I'm sorry.
Well, I was going to say, one of the things that I appreciated about you guys is when we moved over, there were so many things that, as a real estate investor, I just had never really put a lot of thought into it. Like, we need insurance was like, we need insurance, but without a lot of thought into, well, what does that mean? Like, what am I not covered for that I need, and what am I covered for that I'm never going to need?
Sure.
So it's just things like that. But the biggest thing was the realization that through our portfolio, we didn't have to have everything that was either actual cash value, that was cash value, or replacement cost. So we ended up having a mixture of some that ended up, saving us quite a bit of money, because we have especially some lower end houses where the square footage is big, maybe because they added on a couple times, and it's a good rental property. But, we had properties that were insured for, let's put it this way. I have some properties that you have to do kind of a minimum if it's an actual cash value, right? A certain amount for a total loss per square foot, right?
Yeah, in our program we did, and that's kind of anomalous to our program because it's a little bit different. The coverage that we offer is the same coverage, the same policy forms that have been offered for 80, 90 years in the insurance industry, but it's our methodology. So your ability in our program to garner actual cash value coverage, again, avoiding that whole co-insurance issue, is $45 a square foot.
Right. Most
carriers out there, most have come to realize, if you want their coverage, it's a minimum of $80, $90, $100 a square foot. So we kind of give you that ability to kind of get in the game and avoid that co-insurance issue at a lower value. But I think what you're alluding to, and I'd probably expand on a little bit, is you need to look at your portfolio, whether you've got 1 or 100 properties, and look at what would you actually do in the event of a larger total loss. So if you could actually take that property, raise the ground, take whatever actual cash value settlement got and sell the lot, then why would you ever insure it to rebuild it? You really would.
That's exactly right. And that's what we kind of realized is, hey, we have some houses that, I don't have anything that's in the ghetto, but we have some that are in lower end neighborhoods, more of a C-class, working class neighborhood, but houses there are selling for half of build price or something. So if there was a total loss, we would never go build. If we built a new house there, it would instantly be worth half of what we put into it. And so that was kind of looking at it that way. Like, what would we do if we had a total loss? Would I actually fix it back up, or would I just give the lot away and take my claim and run?
Move on and go buy another one somewhere.
That's right.
That's what most investors would do. Now, there's exceptions to that. Let's say you bought this beautiful 4-family that, I'll give you a quick example. We were in Cincinnati for many, many years, and there's an area of town called Batavia. It's on the southeast side of town. I'm sure it's still there. I believe it is. There's a Ford plant down there. So there's always a tenant lined up to get into that 4-family. It was solid brick. You'd never be able to rebuild it for less than, I think it was $800,000. But because of the the ability to have that thing filled, it literally was a cash cow for that investor. They wanted to be able to rebuild it.
Right.
Because if it blew away or got gutted in a fire, which was really because it was solid brick, that was more of the chance of something happening was a fire gutting it. They wanted to make sure they could rebuild it, because in that case, it was literally a goose laying golden eggs every month for them. If they ever lost a tenant, boom, somebody lined up right behind them for it. So, there's always exceptions to that kind of rule of thumb, is to ensure the actual cash value. But if you've got something that you would rebuild for all, many other reasons too, then by all means insure it to rebuild it. And not so much value that the insurance company gives you, as long as you meet their requirements relative to their guidelines of insurability. Make sure you got enough there to rebuild it if that's what you ultimately would want to do.
Yeah.
Loss.
Yeah, I think the important thing is to work with somebody that you can have these conversations with.
Yeah.
That kind of gets what it is you're trying to do, and actually ask questions instead of just what's the address and the square footage, right?
Yeah, it's where you got to start everything. But again, I think my attitude is I'd rather make a client, or I'd rather our team make a client, not so much an expert, but be knowledgeable about certain things that are relevant to their insurance needs, and then make cognizant decisions about it. They're not difficult. I mean, God, if a rocket science, I wouldn't be doing it. That's for sure.
You're a history major.
Yeah, exactly.
Awesome, Tim. Well, hey, if folks want to learn more about you guys, where should they go?
Yeah, probably the website, NRE Insurance, like November, Romeo, Echo, the word insurance.com. And we've even got a knowledge center on there. As long as I've been doing this, I've written quite a few articles for different places, and there's web and blog posts and all that, literally on issues like actual cash value versus replacement cost, what you and I have talked about.
Yeah.
Co-insurance, deductible, what deductible you should carry. So we put some pretty good information on the website in our knowledge center. It's it's free to use. Just go there and just check it out.
Great. We'll add a link down below. And Tim, definitely appreciate your time today, my friend.
No problem, buddy. It's always good to see you.
Good to see you. Take care. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.